Many American working professionals are earning more than they did 5 or 10 years ago, but feel less able to change jobs, reduce hours, or take career risks. The issue isn't motivation, it isn't skill, it's fixed expenses. As incomes rise, fixed financial commitments often rise faster, and that quietly reduces long term career flexibility. Over the past decade, many mid career professionals in the United States have experienced steady income growth. Promotions, role changes, and inflation adjustments have pushed salaries upward. On paper, financial progress appears clear. But alongside income growth, another trend has developed. Fixed expenses have expanded. Mortgage payments, property taxes, health insurance premiums, childcare contracts, car loans, private school tuition, subscription services, higher baseline lifestyle costs. And unlike discretionary spending, fixed expenses don't adjust easily. This creates a subtle financial tension. As comfort increases, flexibility declines. The expansion of fixed costs. When income rises, lifestyle often stabilizes at a higher baseline. Housing is usually the largest shift. Many professionals upgrade from starter homes to larger properties in better school districts. Mortgage payments increase. Property taxes increase. Insurance premiums increase. Maintenance costs rise. These are not irrational decisions. They reflect stability and long term planning, but they lock in monthly obligations. In many metropolitan areas, property taxes alone have risen significantly over the past 5 years. Home insurance premiums have also climbed due to climate related risks and construction cost increases. The monthly housing cost that once represented 25 to 30% of income can gradually approach 35% or more. At the same time, health insurance premiums have continued rising, particularly for employer sponsored family plans. Even when employers subsidize coverage, employee contributions have grown. Childcare expenses, especially in urban areas, often rival mortgage payments. According to recent national data, full-time childcare for one child can exceed $15,000 per year in many states. These are not temporary expenses. They are multi-year commitments. Income growth versus financial rigidity. A common assumption is that higher income equals greater freedom. In theory, that makes sense. But in practice, higher income often supports higher fixed costs, not higher liquidity. Liquidity creates flexibility. Fixed costs create rigidity. For example, a professional earning $120,000 with $7,000 per month in fixed obligations has less room to maneuver than someone earning $90,000 with $3,500 in fixed costs. The first may appear more successful. The second may be more flexible. When fixed costs consume a large share of monthly income, even modest career shifts become complicated. Taking a lower paying role, switching industries, moving to a startup, reducing hours, taking a sabbatical, relocating to a lower cost city. Each decision becomes constrained by the need to sustain existing commitments. The psychological layer. Beyond the math, fixed expenses create psychological anchoring. Once a family adjusts to a certain neighborhood, school district, healthcare network, or standard of living, reversing those choices feels disruptive. It's not simply about money, it's about stability, and stability is valuable. But stability also increases the cost of change. Professionals in their 40s and 50s often describe feeling locked in, not because they dislike their careers, but because altering income would affect too many downstream obligations. The result is career conservatism. Risk tolerance declines, not due to age alone, but due to financial architecture. The role of mortgage structure. Mortgage structure plays a significant role in this rigidity. In recent years, many homeowners secured low fixed rate mortgages during historically favorable interest rate periods. Those rates are attractive. However, they also tie homeowners to specific properties. Selling a home with a 3% mortgage to purchase another at 6 to 7% significantly increases monthly payments, even if the home price is similar. This creates geographic rigidity. Professionals may remain in cities or roles longer than intended because moving would disrupt favorable financing terms. Mortgage comfort becomes location dependency. Retirement contributions add pressure. At higher income levels, retirement expectations also expand. Many professionals increase 401k contributions to meet long-term savings targets. Employer matches encourage this behavior. But higher retirement contributions reduce current cash flow. Again, this is financially responsible behavior. Yet combined with high fixed expenses, it narrows short-term flexibility. If a career change reduces income, professionals often hesitate because it would require reducing retirement contributions, which feels like moving backward. Inflation and baseline cost shifts. Recent inflation has amplified these dynamics. Even as headline inflation slows, many baseline expenses remain elevated. Groceries, utilities, insurance premiums, property taxes, service costs. These increases often become permanent resets. Once monthly expenses adjust upward, they rarely decline. As a result, income growth is frequently absorbed by structural cost increases rather than optional savings. This creates a phenomenon where professionals feel financially stable but not financially mobile. Career plateaus and expense momentum. Mid-career often brings compensation plateaus. Early career income tends to rise quickly. Mid-career growth slows. Late career growth becomes incremental. But expense growth doesn't necessarily slow. Mortgage payments remain fixed. Tuition costs increase. Healthcare expenses rise with age. Insurance premiums climb. When income growth slows while fixed expenses remain elevated, financial comfort transitions into maintenance mode. At that point, preserving income becomes more important than increasing it. And preserving income often means avoiding risk. The hidden trade-off. The hidden trade-off is not visible in monthly budgeting apps. It's visible in optionality. Optionality is the ability to make meaningful changes without financial strain. Examples of optionality include accepting a role aligned with interests rather than salary, taking time off between positions, relocating without financial penalty, transitioning to part-time work, starting a small independent venture, moving closer to family. When fixed costs dominate monthly income, optionality decreases. Professionals may still earn high salaries. They may still save consistently. But the cost of change becomes higher than the benefit of change. Not a crisis, a structural pattern. This dynamic does not represent financial mismanagement. It reflects a structural pattern of middle and upper middle income households in the United States. Higher earnings support higher baseline living standards. Higher living standards create larger fixed commitments. Larger fixed commitments reduce flexibility. The system works efficiently, but it narrows adaptability. Over time, professionals often notice this shift gradually rather than suddenly. At age 30, flexibility feels abundant. At age 45, obligations feel embedded. The difference is not motivation, it's structure. Financial comfort versus financial mobility. Financial comfort means predictable bills, stable housing, reliable healthcare, and steady retirement contributions. Financial mobility means the ability to alter course without major disruption. The two are related, but not identical. In many cases, financial comfort reduces financial mobility. This trade off is rarely discussed in public financial conversations because comfort is considered success. But mobility is a different dimension of success. It determines how easily a person can respond to industry shifts, technological changes, health needs, family obligations, economic downturns. When fixed expenses are high, response options narrow. A long term perspective. None of this suggests that higher living standards are inherently negative. Stable housing, good schools, strong healthcare coverage, and consistent retirement contributions are positive developments. The question is not whether comfort is valuable. The question is how much flexibility remains after comfort is established. In earlier career stages, income growth increases both comfort and flexibility. In mid career, income growth often maintains comfort, but does not expand flexibility at the same rate. That distinction becomes more visible over time. Professionals who recognize this pattern early tend to observe it more clearly in their 40s and 50s. The issue is rarely dramatic, it is gradual. And because it is gradual, it often goes unnoticed until a major decision arises and feels harder than expected. Closing reflection. Higher income does improve financial stability. But when higher income is matched by higher fixed commitments, long-term flexibility can quietly decline. For many American professionals, the challenge is not earning more. It is preserving optionality while earning more. Financial comfort provides security. Flexibility provides choice. Over time, the balance between the two shapes not just wealth, but the range of possible futures.